In the financial world, there are truths that are repeated so often that they seem unshakable. One of them is, keeping money in the bank is the safest thing to do. But according to Robert Kiyosaki, author of Rich Dad, Dad in 2025, that security could be your worst enemy. Inflation, central bank policies, and the growing distrust of traditional currencies are turning savings into paper that's worth less every day. What you think protects you is actually impoverishing you. That's why Kiyosaki insists that the path to wealth isn't accumulating cash in a bank account, but rather moving it into 3 specific assets. These assets not only withstand crises, but, if used properly, could multiply your wealth and lead you to financial independence sooner than you imagine. In this video, we'll break down these 2 investments and understand why they could be the key to becoming a millionaire next year. Write in the comments, "I am financially free." Do this not as a mechanical gesture, but as a personal statement, because true wealth begins in your mind before it reaches your pocket. Strategy 1. Short-term bonds. Stability in the storm. In a world where financial news changes faster than the weather and where a tweet can move billions in seconds, finding a stable haven may seem impossible. But Kiyosaki reminds us of something many have forgotten. Not all investments need to be spectacular to be effective. Short-term bonds are like a lighthouse in the middle of a storm. They won't take you quickly to a new destination, but they will keep you from crashing on the rocks. Unlike long-term bonds, which can be greatly affected by changes in interest rates, short-term bonds generally have maturities between 1 and 3 years and offer greater predictability and less exposure to volatility. Why can they be key to your strategy? Moderate but secure returns. While they may not generate explosive gains, they can exceed the returns of a traditional savings account and, in some cases, match or exceed inflation. Lower interest risk. If rates rise, the impact on the price of a short-term bond is much less than that of a long-term bond. Faster liquidity. Capital is quickly available for reinvestment depending on market conditions. For example, in 2024, some 2-year U.S. Treasury bonds offered annual yields of over 4.5%, well above the average for savings accounts, which ranged between 0.5% and 1.5%. For an investor looking to protect their capital and maintain a positive return, the difference is significant. Kiyosaki emphasizes that these bonds are especially useful for those approaching crucial goals. People approaching retirement, where a loss of capital would be difficult to recover. Parents who need funds for their children's college tuition in a few years. Investors who are waiting for an opportunity in the market but don't want their money to be eroded while they wait. The key is not to see it as the investment that will make you a millionaire, but as the tool that will preserve your capital while you build your next financial move. It's like putting your ship in a safe harbor while the storm passes and then setting sail again for more profitable seas. Strategy 2. The true purpose of cash. Cash in idle hands is like a river whose course is blocked. The water stops flowing, stagnates, and over time loses purity. For Robert Kiyosaki, cash is not the end of the road, but the vehicle to something greater. Storing it indefinitely in a savings account, believing it to be safe, is like buying seeds and leaving them in a box, hoping that one day they will grow into trees. The real function of cash is to fuel assets that generate more value. It's dry wood ready to feed a fire, but it's useless if the spark never ignites. And here's the problem. In most countries, the interest rates that banks pay on savings accounts are far lower than actual inflation. For example, if your bank offers you 2% per year for your money, but inflation is at 6%, you're losing 4% of your purchasing power each year. In 5 years, that's equivalent to having burned almost 20% of the real value of your capital without having touched a single bill. The system is designed to make you believe that saving is protecting, when in reality, it's handing your money over to a mechanism that slowly erodes it. Banks use savers' cash to make loans, invest in markets, and earn returns far higher than what they pay. In other words, they do what you don't dare do, but with your money. Kiyosaki proposes a radical change of perspective. Don't see cash as a treasure to be safeguarded. See it as a temporary tool that must be quickly transformed into productive assets: real estate, businesses, strategic bonds, precious metals, or solid cryptocurrencies. When we treat cash as a final destination, we not only condemn it to losing value, we also become trapped in the illusion of security that banks have sold us for decades. But when we treat it as a bridge to something bigger, we open the door to true wealth building. Comment: I accept success and happiness in my life. Because financial happiness begins when you stop working for money and make money work for you. Strategy 3. The invisible enemy: inflation that never sleeps. Imagine you have a bucket full of crystal clear water, and every day, without you noticing, someone drills a microscopic hole in the bottom. You don't notice it at first, but after a while, the level drops, and before you realize it, much of the contents have been lost. That bucket is your bank account. The water is your money, and the hole is inflation. Robert Kiyosaki describes inflation as a silent force, an enemy that doesn't need to attack you head-on to destroy your wealth. It doesn't present itself with big headlines or alarm bells. It acts slowly, steadily, eroding the purchasing power of your money while you continue to believe it's safe in the bank. The numbers are cold and overwhelming. According to World Bank data, an annual inflation rate of 4% means that in 10 years, your money will have lost approximately 33% of its real value. If inflation is 7%, the loss in value over a decade exceeds 50%. In other words, if you keep $10,000 in an uninvested account today, in 10 years with moderate inflation, that money will only allow you to buy what would cost between $5,000 and $6,500 today. The problem isn't just rising prices. The real driver of inflation, according to Kiyosaki, is the expansionary monetary policy of central banks. When they print money to save the economy or finance bailouts, they are increasing the amount of banknotes in circulation. And when there is more money chasing the same amount of goods, prices inevitably rise. This isn't theory. Between 2020 and 2022, the U.S. Federal Reserve printed more than 40% of all dollars in circulation in the country's history. The result was inflation that reached levels not seen in more than 4 decades. Meanwhile, savers who relied on banks to protect their money saw their purchasing power fall month after month, without the interest on their savings accounts even coming close to keeping pace with prices. Kiyosaki sums it up with a phrase that hits like a hammer: saving cash is like trying to stop the bleeding with a torn Band-Aid. The message is clear: money that isn't moved into assets that protect it inevitably devalues. It's not about spending for the sake of spending, but rather understanding that cash is like ice in the sun. No matter how much you have, if you leave it exposed, it will disappear. Strategy 4. The variable rate debt trap. In the financial world, there are chains you can't see until they start to tighten. One of the most dangerous is variable rate debt. At first, it sounds attractive: low initial rates, affordable installments, the promise of flexibility. But in an environment where interest rates are constantly rising, that apparent advantage can turn into a deadly risk for your finances. Kiyosaki explains it clearly. Every time the Federal Reserve or your country's central bank raises rates, your debt automatically becomes more expensive. If the rate rises by 1%, that small increase can mean hundreds or thousands more in annual payments, depending on the size of the loan. This type of debt acts like a sponge that absorbs your cash flow. And the worst part is that you have no control over when it will become more expensive. The power to decide is in the hands of central banks, not you. Therefore, reducing or eliminating these debts is a way to protect your future. Kiyosaki advises prioritizing paying them off over other debts because their volatility makes them unpredictable. By freeing yourself from them, you not only gain peace of mind, but you also regain your ability to maneuver. That money that used to go to the bank can now go into an asset that generates real income and works for you day and night. Financial freedom isn't just about having more income, it's also about having fewer obligations that take away your power. Write in the comments, "I accept success and happiness in my life." Because every debt you pay off is a space you open for something better to enter: opportunity, prosperity, and peace. Strategy 5. Gold and silver, guardians of value. In the economic history of humanity, few things have demonstrated as much resilience as gold and silver. They are the silent guardians of value, witnesses to empires that rose and fell, to currencies that were born and died. Kiyosaki compares them to a wall that protects wealth from the passage of time. When a national currency collapses, when banks close their doors, when trust collapses, gold and silver continue to be accepted, recognized, and valued everywhere in the world. They don't need a decree to be valuable, because their value is not imposed, it is intrinsic. Historically, every financial crisis has seen these metals strengthen. During the 2008 crisis, for example, gold went from around $800 an ounce to more than $1,800 in just a few years, while millions saw their savings evaporate in bank accounts. Silver, although more volatile, has doubled or tripled in value during periods of global instability. The key is that its supply is limited. You can't print gold or silver like you print money. Extracting them requires time, labor, and resources. This scarcity, coupled with their universal acceptance, makes these metals a natural haven for capital in times of uncertainty. Kiyosaki recommends not viewing them as a speculative investment, but rather as a value insurance. Just as you take out insurance on your home, gold and silver protect your assets against the erosion of purchasing power and market instability. They don't generate cash flow, but they do generate stability, and in a crisis, stability is gold. Strategy 6. Bitcoin, digital gold. On the global financial chessboard, Bitcoin has become a piece that neither governments nor banks can move at will. Kiyosaki calls it digital gold, not by chance, but because it shares a fundamental characteristic with the precious metal. Its supply is limited. Only 21 million Bitcoins will ever exist, and every day that passes makes it more difficult and expensive to mine a new one. This mathematical scarcity protects it from the artificial inflation generated by central banks printing unbacked money. Its decentralized nature is another of its strengths. It doesn't depend on a single entity. It can't be frozen by a court order or devalued by decree. This gives it something that fiat money lost decades ago: trust based on unbreakable rules, not political promises. Of course, it's not a risk-free asset. Its volatility is well known. It went from being worth less than $1,000 in 2017 to over $60,000 in 2021, only to fall below $20,000 at times. However, those who understand it as a long-term reserve asset aren't driven by the panic of fluctuations, but by the vision of its growing adoption around the world. In countries experiencing severe monetary crises, such as Venezuela, Argentina, and Turkey, Bitcoin has become an escape route for millions of people seeking to protect their purchasing power. And although governments attempt to regulate or limit it, the network is global, resilient, and increasingly accepted as a means of payment and store of value. Investing in Bitcoin isn't betting on a future price, it's betting on a new financial paradigm where control returns to the individual. Therefore, for Kiyosaki, having a portion of your assets in this digital currency isn't speculation, but rather intelligent diversification in the face of a fragile financial system. He comments, "I am prosperous and I attract wealth." Because opening yourself to new forms of investment isn't just a financial move, it's opening the door to new horizons of economic freedom. Strategy 7. Diversification as an art. In the investment world, concentration can be lethal and diversification can be a lifeline. Kiyosaki puts it clearly. It's not about guessing the perfect asset, but about building a portfolio that can withstand any storm. Think of a defensive wall. If it's made only of mud bricks, a strong blow will bring it down. But if you build it with stone, cement, and steel, the structure stands firm against any impact. The same goes for your assets. Short-term bonds. They provide stability and liquidity. 20% of your portfolio here can act as a cushion against downturns. Precious metals. Gold and silver protect against inflation and currency devaluation. 15 and 20% provide a value anchor. Cryptocurrencies. They provide growth potential and a hedge against a weakened financial system. 5% and 10% are enough to expose yourself without taking excessive risks. Productive assets. Rental properties, businesses, or dividend-producing stocks. The rest of the portfolio should be targeted here to maintain a steady stream of income. Diversification isn't random, it's intentional balance. It means that when one sector suffers, another compensates. It means you're not dependent on the whims of a single market to protect your future. Kiyosaki often says that the average investor loses money because they bet everything on one horse. And when that horse stumbles, everything collapses. The wise investor, on the other hand, understands that wealth is built like a symphony. Each instrument, however different, contributes to the final harmony. Strategy 8. Turn fear into action. Most people, when they hear the word crisis, think of losses, cutbacks, and danger. However, great investors, including Kiyosaki, know that crises are where the greatest fortunes are made. If we look at recent history, during the 2008 crisis, while millions of people were paralyzed by fear, prepared investors acquired real estate at discounts of up to 50%. In the 1970s oil crisis, those who bet on energy assets multiplied their capital several times over. The pattern repeats itself. Massive fear creates opportunity prices. Kiyosaki explains that the key is not to ignore fear, but to transform it into a driver of calculated action. Fear paralyzes those without a plan, but it drives those with clarity. If your finances are diversified, as in the previous strategy, if you maintain sufficient liquidity and know the sectors with potential, you can turn every collapse into an open door to prosperity. A practical example. Suppose you keep 20% of your portfolio in cash or liquid bonds. If the stock market falls 30% during a crisis, that capital becomes your ammunition to buy quality assets at historically low prices. What for others is a disaster, for you can be the beginning of a decade of accelerated growth. This isn't simple optimism, it's strategic vision. It's understanding that in the financial world, storms aren't avoided, they're navigated. And those who learn to navigate rough seas end up reaching ports others never imagined. Comment: I accept success and happiness in my life. Because deciding to act in times of fear is more than a financial move. It's an affirmation that you don't let circumstances decide for you. Strategy 9. Financial education, the invisible asset. You can inherit a fortune, win the lottery, or close the most successful business of your life. But if you don't understand how money works, that capital has an expiration date. Robert Kiyosaki repeats it over and over again. Financial education is not a luxury, it is the foundation upon which all lasting wealth is built. Most people spend years studying to earn money, but very few take the time to learn how to protect it, multiply it, and make it work for them. According to the OECD, more than 50% of adults in developed economies don't understand basic concepts like compound inflation or risk diversification. This knowledge gap is the reason why so many fortunes evaporate in less than a generation. Financial education is an invisible asset because it's not visible in your bank account, but it's reflected in every decision you make. It's the compass that allows you to navigate an ocean filled with tempting offers, quick promises, and hidden dangers. Without it, any economic storm, a banking crisis, a recession, or a rate hike can sink your ship in a matter of months. Kiyosaki advises setting aside a fixed percentage of your monthly income, even if it's small, for education. Reading specialized books, attending seminars, understanding financial statements, and practicing simulated investments. This constant learning is what transforms a saver into an investor, and an investor into an empire builder. Because in the end, financial freedom isn't measured just in numbers, but in the security of knowing that, no matter what happens in the global economy, you have the tools to adapt and prosper. Strategy 10. The philosophy of making money work for you. For most people, money is like a demanding boss. If you don't show up for work, it stops flowing. For Kiyosaki, that mentality is an invisible prison. True freedom doesn't come when you have more income, but when that income doesn't depend on your physical presence or your limited time. Changing your relationship with money means stopping thinking like an employee and starting to act like an asset owner. This doesn't necessarily mean owning a large company from day one, but rather acquiring or creating sources of income that function automatically or semi-automatically. These could be rental real estate, stock dividends, royalties from intellectual property, or income from digital businesses. A clear example: if you invest $100,000 in a property that generates a net return of 8% per year, you would receive $8,000 a year without having to work overtime. And if that $8,000 is reinvested, the snowball grows, allowing every dollar you own to become a worker who never sleeps, never gets sick, and never takes a vacation. Kiyosaki explains this with a simple analogy. The poor work for money. The rich make money work for them. This isn't magic, it's strategy. It involves time, patience, and a willingness to sacrifice immediate consumption to build assets that generate future cash flow. The question we should ask ourselves every time a dollar comes into our lives isn't, what do I spend it on, but how can I make it bring me more dollars without my constant intervention? Robert Kiyosaki's message isn't a prediction, it's a warning. Money in the bank is no longer synonymous with security. True protection lies in moving it, multiplying it, and transforming it into real assets. If this resonated with you, it's no coincidence. It means you're ready for the next step on your path to financial freedom. Subscribe and let's continue together, because what's coming next can change not only your finances, but your entire life.